If you're looking at buying a home or refinancing, one of the first questions you probably ask is what's the interest rate? And that makes sense. The interest rate is a number that everyone sees. It's the number that gets advertised, it's the number that banks compete on, and it's the number that comparison websites rank lenders by. But here's something that might surprise you. In most cases, the interest rate is actually the least important factor when choosing a home loan, and it's usually the very last thing that we look at. Now that doesn't mean that rate doesn't matter. Of course it matters. You don't want to be paying more to the bank than you already are, and you don't want to be sitting on a loan that's uncompetitive, just giving money away. But just because there's a low rate advertised somewhere doesn't mean you'll qualify for it. And even if you do qualify for it, it doesn't automatically mean it's the right loan for your situation. So in this video, what I want to do is break down what actually matters more than interest rate, what we look at before we even start comparing rates, and why choosing a loan purely on rate can sometimes cost you far more in the long run. Let's start with what I believe is the most important factor for most borrowers: bank policy. In my opinion, bank policy is usually the single biggest factor that determines whether you can get a loan, how much you can borrow, and how smooth the process will be. And most people don't even realize it. Every lender has their own credit policy, and on the surface they may look similar, but when you dig into the details, the differences can be massive. Bank policy determines what income is accepted and what isn't. It determines how that income is assessed. Two banks can look at the exact same payslip and calculate your borrowing capacity completely differently. It heavily impacts borrowing capacity, and when I say heavily, I mean it can be the difference between getting into the market and missing out entirely. Policy determines how long you need to be in your current job. Some lenders are comfortable if you've recently changed roles within the same industry. Others want to see longer history in the exact same position. It determines how long you need to be earning overtime, allowances, or bonuses before they'll count it as income. One lender might accept it after a short period with supporting evidence. Another might want to see it consistently over a much longer time frame. Self-employed policy varies even more drastically. Some lenders expect you to have been self-employed for a significant period and require multiple full years of financials before they'll even consider your application. Others are more flexible and can work with less history, depending on the overall strength of the file. And if you're a first home buyer looking to use a government scheme, not every bank participates in every scheme. So even if a lender has a great rate, if they don't participate in the scheme you're eligible for, that rate becomes irrelevant. LMI waivers are another big one. Some lenders will waive lenders' mortgage insurance for certain professions or scenarios, others won't. That can have a huge impact on your overall costs. Policy also determines which properties are acceptable security. Some banks will only accept certain postcodes and certain property types. There's also many more things in policy that needs to be considered. Maximum loan to value ratios vary, guarantor loans vary, construction loan policies vary, equity release conditions vary, and genuine savings requirements varies. This is just a fraction of all the different policies that we assess. And all of this happens before we ever look at interest rate. So if you walk into a branch or jump online and say, what's your best rate? You're skipping the most important step, which is, will this bank actually work for me? Closely linked with policy is borrowing capacity. Borrowing capacity can vary significantly across lenders, even when your situation doesn't change at all. Same income, same expenses, same deposit, completely different result. That's because different banks assess income differently. They assess living expenses differently, they assess debts and commitments differently, and in today's market, borrowing capacity matters more than ever. For a lot of buyers, especially first home buyers or people trying to purchase their first investment property, getting into the market often means stretching their borrowing capacity. Now, I'm not saying you should always borrow to your maximum. In fact, in most cases, I don't recommend it. You need to have buffers and you need to have breathing room. But in reality, many people are choosing to borrow close to the maximum in order to secure a property and get into the market. And if your borrowing capacity with one lender is significantly lower purely because of their policy, a slightly cheaper interest rate isn't going to help you if you can't buy the property you want. The The next factor that's often overlooked is assessment time. In a competitive market, speed can be everything. Some lenders might offer a slightly sharper rate, but if their approval process takes weeks and the property you're trying to buy has multiple offers on it, you may not even get a chance to use that rate. Most sellers don't want long finance clauses, especially if there are other buyers ready to move quickly. A quick assessment time gives you confidence to make stronger offers. It allows you to negotiate shorter finance clauses. In some cases, if we're confident in approval, it can even allow for unconditional offers. On the other hand, if a bank is slow and the approval drags out, you risk missing out on the property altogether. Now, if you're refinancing and there's no purchase attached, assessment time is usually less critical. If a refinance takes a few extra weeks, it's often not the end of the world. That's where we can be more selective purely on the rate and if everything else lines up. But when you're purchasing, speed can be more valuable than a marginal rate difference. And once you have the property, it's much easier to refinance to a cheaper rate in the future. Now we're going to look at product features, because not all home loans are created equal. Offset accounts are a big one. You need to be asking, are they available? How many can you have? Are there monthly fees? Some lenders offer unlimited offsets with no additional cost. Others charge per account or limit how many you can link. Redraw is another feature people assume is standard, but it might not always be available and different banks might have different rules. These details matter, especially if you plan on making extra repayments and want that flexibility. If you want fixed rates, we need to ask, are they available? What terms are offered? Are there restrictions attached? Most lenders don't offer offset accounts for fixed rate loans, but there's also a select few that do, so this needs to be considered. Then there's loan splits. Are you able to split your loans easily? This becomes especially important for people investing, debt recycling, or structuring their loans for tax purposes. The last feature I'm going to mention is interest-only options. These are very popular for investors, but not offered by all lenders or available for all situations. If you choose a lender purely because they have the lowest rate, you may get stuck without the features you want or with a loan that isn't structured to best suit your needs. Now let's talk about fees. This is where a lot of people get caught. Some lenders advertise very competitive interest rates, but only if you're part of a package. That package often comes with an annual fee. Sometimes it's a few $100s a year, sometimes it's more. Offset account fees can also apply monthly. Some lenders will offer unlimited offset accounts at no cost. Others will charge you for the privilege, such as $10 a month. Most lenders also charge additional fees. There can be application fees, settlement fees, valuation fees, and even more depending on the situation. And if you fix your rate, you may choose to pay a rate lock fee. There may be break fees if you exit early, and there may be fees for making extra repayments. And if you're thinking about refinancing in the future, there are also discharge fees to consider. All of these costs need to be factored in when comparing loans. A slightly lower interest rate doesn't automatically mean the loan is cheaper overall. Once we've gone through policy, borrowing capacity, assessment times, product features and fees, then usually we'll have a short list of lenders that actually suit your situation. That's when interest rate comes back into the conversation. At that point, we're comparing lenders that we already know work for you. We know they'll accept your income. We know they'll give you the borrowing capacity you need. We know they have the features you want, and we know the fees are reasonable. Now we can compare the rates. Sometimes, once we narrow it down, there are still multiple strong options and rate becomes the deciding factor. Other times, after filtering through all the previous mentioned criteria, there might only be one lender that truly suits your situation. In that case, comparing interest rates across the entire market becomes irrelevant because the other lenders were never viable options to begin with. And this is where I want to touch on why we operate the way we do. As brokers, we all have access to the same rates across lenders. I'll never try to sell my service based on saying that I can get you a better rate than someone else. What makes a good broker isn't access to rates. It's the ability to understand the details of your situation and pair you with a lender that actually fits. It's understanding bank policy, It's understanding your income and how it'll be assessed. It's understanding which lenders are quick, which are slow, which are flexible, and which are strict. It's understanding which product features matter for your long-term plans and not just today. And it's building a structure that supports your goals, not just chasing the lowest number on a comparison website. So when someone asks me, what's your best rate? My answer is usually, it depends. It depends on your income. It depends on your deposit. It depends on your goals. It depends on whether you're buying, refinancing, investing, or building. And it depends on what you're trying to achieve over the next 5, 10, or 15 years. Interest rate is important, but it's the final piece of the puzzle, not the starting point. If you're thinking about buying or refinancing soon and want to make sure you're looking at the full picture rather than just the rate, you can book a chat with us via the link down below. And if you found this video helpful, please subscribe and leave a like, and leave a comment on what topic you'd like to see next.